Congratulations! You own an asset that's worth more today than when you first bought it. Your increased value could be in commercial real estate, a vacation house near the beach, or highly appreciated shares of stock. Your decision whether to sell or hold on to the profitable asset is influenced by taxes. In the Internal Revenue Code, it's the determination of amount of and recognition of gain or loss. Computation of gain or loss decides whether you'll have to pay a federal income tax on the profit, called a capital gains tax. The gain from the sale or other disposition of property shall be the excess amount realized over the adjusted basis. Basis is the total amount of money you've invested in the property. If you bought the vacation house for $50,000 and you spent another $50,000 to fix it up, your basis is $100,000. Property values have been steadily rising and the property is worth $500,000 today. If you sell it, you'll pay a percentage of your $400,000 gain to the U.S. Treasury and to the Massachusetts Department of Revenue. Another example, if you bought 10 shares of Apple stock for $1 a share, your basis is $10. If the shares split and grow in value to $1,000 by 2014 and you sell them, you'd pay federal and state capital gains tax on your $990 gain. But if a person holds on to appreciated assets during their lifetime and hands the assets to someone else upon death, there won't be a capital gains tax. The basis of property acquired from a decedent who passes away is not subject to income tax. The basis of property in the hands of a person acquiring the property from a decedent will be the fair market value of the property at the date of the decedent's death. This is called stepped-up basis. It gives your family or whomever you remember the full fair market value of the property, so they can take the profits tax-free. If the Apple stock is worth $1,000 upon the death of the owner, the stock can be sold for that amount with no income tax. Taxation of income in Massachusetts follows the federal adjusted basis rules. Property acquired from a decedent gets the same stepped-up basis under the Massachusetts income tax law. If surviving family members decide to sell the real estate, stocks, or other assets, they pay no income tax on gain up to the fair market value on date of death. Now, here's an important exception to remember. The information in this video does not apply to income in respect of a decedent. That comes from inherited tax-deferred accounts like IRA and 401k accounts and U.S. savings bonds. That income is subject to income tax under another section of the Internal Revenue Code. For assets that are not in qualified tax-deferred accounts, there are several ways to hold the asset during lifetime and transfer upon death to get the stepped-up basis.